Thanks, Doc. Appreciate you. All right, let's go to our. Okay, now we will continue with chapter 2, and we will start with the T account. Now, the T account. Okay, the T account is a way to sum up or to know where you are for some specific account. For example, before we look at the components of it, if I want to see how much is my balance in cash, or how much is my balance in accounts receivable, I would use a T account. If I want it in a very fast manner, right now I want to see my balance in cash, so I would do a T account, and at the pluses and the minuses, pluses and minuses, and then I will end up with the balance. That's what the purpose of the T accounts. Before we do that, so let's understand what's the components of the T account. All right, it looks like just like the letter T. That's why it's called T account, because it looks like the letter T. And once you do the T account, draw it, all right? And on the top here, you will have the title. And that title could be any account, whether it is an assets account, liabilities account, or owner's equity account, okay? And then you have the left side and the right side of the T account, and then you would have, so the left could be, say it again, yeah, there is always the debit side, or you can say, instead of the word debit, you could say DR, all right, DR with a dot, like that. And the left side is always the credit side, or CR, right? So these are the components of the T account. And then you will have, you add all the left sides, all right? And then you get the total. And you add all the right side numbers, account amounts, you get the total, okay? Whichever is the highest is going to be the balance. All right, let's say the total on the left side is 200 and the total on the right side is 150. So which one is the highest? 200, the debit. So by how much? By 50. So the balance is on debit side with 50. All right? Good morning. Good morning. All right, so these are the components of the T account. As you can see, this is the left side is the debit side, and the right side is the credit. Left side debit, right side credit. And it looks like the cash has five transactions. Has 100,000. 3,000 on the left side, and these are on the right side. As you can see, the left side total 103,000. The right side totals 71,600. Which one is larger? The left side, which is the debit side. And by how much? So the balance of cash is, as of this moment, is 31,400. Now we, as far as the pluses and the minuses, okay, we're going to learn that in a minute, yeah. But cash happened to be an asset, correct? And the assets, when they increase, they are debited. When they decrease, they are credited. Yeah, we'll come to that in a minute, yeah. Just I want you to understand what is the T account and what is the purpose of the T account. All right? So, all right. Now, just the rules of the double entry accounting, like we said last time, the double entry system says what? Every transaction has two sides.
At least one debit and one credit.
You know, each side with at least one debit and one credit, or two credits and one debit. All right. So that is double entry. So every transaction you have to know what the two parts are. Remember last time when we talked about the classification? Okay, you have to find out those two sides. First you say whether they are assets, liabilities, or owner's equity, and then you specify what kind of asset is it, all right? What kind of liability? Is it cash, account receivable, and like that, all right? We're going to do a practice in a few minutes, all right? And I think it will become clearer when we practice. All right, keep the accounting equation in mind as we do our analysis. Yeah, assets equal liabilities plus owner's equity. Just remember that. That's and what is that balance sheet? What's that equation is?
Balance sheet.
Balance sheet equation. And what's the other name for the balance sheet? What did we say? I'm going to ask you this every day.
Assets.
Yeah, but
The financial position.
financial position. So the financial position, the accounting equation, that really refers to the balance sheet. The balance sheet is the financial position. All right? Okay. Now, withdrawals and expenses are deductions from owner's equity. Let me, before we go, I'm going to stop over here and start giving you the rules. All right? As we know, the accounting equation is assets equal liabilities plus owner's equity. That's the equation, all right? Now, let me do a T account for all assets, a T account for all liabilities, and a T account for owner's equity. Under owner's equity, Mr. Bailey, how many accounts we have under owner's equity? Remember the formula? What does the formula have?
Beginning balance.
The capital?
You got the additional investments, if any.
So we have the capital
Beginning balance.
and
Additional investments,
Uh-huh.
if any. Then you got your net income.
which is,
Your revenues minus expenses.
yes,
Then you got your
revenues and expenses. All right, I'm making two accounts under owner's equity. The capital, revenues and expenses. And withdrawals, one more. Yeah, one more withdrawals. All right, W is for withdrawals. All right, for assets, regardless of what kind of assets, this is the title. When assets increase, they are debited. When assets increase, if whether this is cash, accounts receivable, land, building, equipment, notes receivable, supplies, all of those, when they increase, they are debited. So we put them on the debit. When they decrease, they are credited. So if the cash goes down, then you will have to credit it. Now, if you understand these rules, you're going to be really good in accounting. If you understand these rules, all right, you got to have those on a card. I should have brought some card with me to give you. Write this on a card and always look at it, or have it on a sheet of paper, and have that sheet of paper next to you all the time. Okay? So when assets are increased, they are debited. When they decrease, they are credited. So if we say, for example, purchased supplies for $500 in cash. I paid cash for them. And if I want to have a T account for cash, okay, we say the left side is debit, and they increase over here, and credit is the right side, decrease. So what happened to the cash here?
It's gonna be debited because you haven't used the supplies yet, so it's still an asset, so it's gonna be like.
Do you all believe that, what he just said? What happened to the cash, I'm saying?
He spent.
Spent, correct?
Yeah.
So that means the cash is
Credited.
credited down. The cash has been used, correct?
Yeah, but that's what.
I'm not worried about the supplies.
Oh, okay.
Just the cash, see?
Oh, alright.
That says the cash. Now, if I want to do one for supplies, then you are right.
Oh, okay.
500, yeah. 500 debit for the supplies, and the cash is down for 500. Got that? So the transaction is a purchase of supplies. The two, remember what the double entry says? Every transaction has two sides. One with debit, at least one debit, and then one credit, or one debit and two credits. So in this case, here's the transaction. The two sides are the supplies and the cash. One is debit, the supplies. One is a credit, which is that cash. Okay? We okay on that now? Alright, so you understand the rule. When assets they are increased, they are debited. When they decrease, they are credited. Alright. Okay, this I put the examples here. So these are the assets. Okay. Liabilities are the opposite. Exactly the opposite. Liabilities. Okay, this is the title. Alright, and this is the left side is debit. Right side is credit. That's the T account, always like that. And so liabilities, when they increase, they are credited. And then when they decrease, they are debited. So liabilities are the opposite. Right? When they increase, they are credited. When they decrease, they are debited. So, going back to the other example, purchased supplies on credit for $500. On credit for $500. The two sides are the supplies and what do you see cash here? Credit, yeah. And what do you call this kind of credit?
Call it?
Accounts payable. It's a liability, correct? We purchased supplies on a liability base. We didn't pay cash for it. So we have a liability. Our liability increased, correct? But you cannot just say debit or credit liability. You have to specify which account under liability. In this case, it is accounts payable. So if I were to do two T accounts, one for accounts payable, okay, and the left side is always debit, right side is always credit. What happened to accounts payable? Did it go up or down? We created it now, correct? That means our liability increased, the accounts payable increased. So therefore, where should we put the 500? And here, 500. And then the supplies is going to still have the 500 there. All right? So regardless of what the liability is, whether it is accounts payable, notes payable, salaries payable, utilities payable, taxes payable. What's the other one that we said that when you get the money in advance and you don't earn it until you, what did we call that? You don't earn it until you do the service. What?
Services to be performed.
No, what's the other name for it? Unearned revenue. Unearned revenue is a liability. Okay, unearned revenue. So it will fall under this rule, the same rule, unearned liability. So if you have a laundry and I give you $500 and I brought a sack of laundry, told you, okay, do this and here's the $500 in advance. You haven't earned that yet. Even though you have it, you have the cash, but you haven't created any revenue yet. So it's a liability on you until you do the job. Yeah. All right. So this is the rule of liabilities. Okay. When liabilities increase, they are credited. When they decrease, they are debited. All right. Now for owner's equity, it depends on the account under owner's equity. We have 4 accounts under owner's equity. We have the capital, we have the revenues, we have the expenses, and withdrawals. 4 accounts under owner's equity. Now, let me give you this general rule. The capital, revenues, and liabilities, they are treated the same way. Capital, revenues, and liabilities, the same rule applies. That means when they increase, they are credited. When they decrease, they are debited. So, debit, credit, debit, credit, debit, credit. So capital, when it increase on the right side and decrease on the left side, just like liabilities. Just like liabilities. And revenue, when it increase, also on the right side, and when it decrease on the left side. All right, so for example, all right, you did worth of $200 out of $500. You earned $200 out of those. So you have a revenue now. You have a revenue, and so let's call it service revenue or laundry revenue. Well, let's just say service revenue. Service revenue. All right. It will have its own account. All right. The debit on the left side, credit on the right side. And so where should we put the $200 you earned? On the credit side. And your unearned revenue will go down now. So that's a revenue. All right. Now let's say that you started your business, your laundry business, by investing $10,000. Okay, let me write this transaction over here, and I'm going to refer that. Oh, I'll just do it right here. Started the business by investing $10,000. All right. Now, what the double entry accounting says? It says every transaction has two sides. Yes. So for this transaction, what are the two sides? I can immediately say one of them you should not even think about it, the cash. Yeah, one of them is the cash, and the other one is capital. Every time you start a business with an amount of money, it's going to be your capital. Whenever you start the business by bringing in money, that is going to be a capital. Sometimes you start your business by cash and bringing in some equipment. So both of these are going to be your capital, equipment and the cash. All right. So in this case, the cash. What happened to the cash? Did it go up or down? Why it went down? Not your personal cash, the business cash. Yeah. Now be careful. Here's another thing you got to be aware of here. If this is not your personal cash, it is the business cash. So the business, we're not worried about your personal cash. We're worried about the business cash. So the business cash increased. Therefore, it is going to be for cash. Where should it be? Here or here? For cash. Debit. Okay, it's going to be here. Now for the capital, where should it be? The $10,000 for the capital. Did the capital go up or down? Went up. Now don't guess now. Yes, it's a credit. Yes, sir. So the 10,000 is going to be in here. Okay, the 10,000 is going to be in here. So let's say this is a accounting firm, not a laundry business. Let's say, or maybe some other business. What kind of business here? Give me a business that started. The owner started with $10,000. Other than laundry.
A maid service.
Which one?
Like cleaning up out like a maid.
Other than that. Okay, restaurant.
Restaurant.
All right, let's say. All right, restaurant. Let's say that you have worked worth of 1 week, and you made $5,000 revenue. Okay, $5,000 revenue. So how do you? And you collected the money, correct? You collected $5,000. Performed services. Performed services for $5,000. All right, in cash. So what are the two sides of the transaction? Yes, service revenue and the cash. Cash and revenue, right? What happened to the cash of the business? Went up, therefore, where should I put it? On the right side.
Yeah, you just point at the wrong.
Yeah.
Oh, sorry, here.
No, the
Yeah.
revenue's over there though. That's what
Huh?
we're talking about, right? We're talking about the revenue, right?
Yeah, that's fine, but the cash going up too.
Yeah, we're talking about.
So the cash is going to be 5,000 here, and the revenue is going to be 5,000 here. So notice that one debit 5,000 and one credit 5,000, so the equation balance. Every time you do a transaction, the accounting equation must balance. The left side must equal the right side. Oh, remember we said when you do transactions, have that equation on mind. All right, have it on mind. Assets equal liabilities plus owner's equity. Always have that on mind. This is the left side. This is the right side. Assets left side, liabilities and owner's equity on the right side. So every time you do transaction, this equation must balance. The total left side must equal total right side. All right. Okay, let's say that you paid a utility bill, paid another transaction, paid utility bill for $200. Paid utility bill for $200. So what are the two? First, identify the two parts.
That's expenses, right?
Yes, sir. Utility expense and the cash. Yes. Now, what happened to the cash? So the cash is going to be down by 200 and utilities expense. So we're going to have a new T account for utilities expense. Now, but that's the general. Yeah, this is the generic. So you may have, for every account, you will have a T account. Utilities expense, you have account. Supplies expense, you will have an account. Salaries expense, you have account. Yeah, every time you have a new thing comes in, you have to open a new account for it. Okay? So, huh?
You have hella bank accounts.
Yeah, because you know, businesses have hundreds of accounts. Businesses, corporations have hundreds and hundreds of accounts. Sometimes they have miscellaneous also accounts, miscellaneous expenses. But the rule is still the same. As long as it's expense, you rate it with this rule. Okay? All right. Let's say that Mr. Manning is the owner of the business, and he withdrew $600. Another transaction, withdraw. How many we said? $600. So what are the two parts of this transaction? Say again? Yes, withdrawal and cash. What happened to the cash? Yeah, therefore the cash is going to be here down by 600, and we have a new account withdrawals. And also withdrawal is treated exactly the same as assets. Okay? Like we said, assets, expenses, and withdrawals are treated the same way. That's the easiest way to remember. Assets, expenses, and withdrawals, when they increase, they are debited. When they decrease, they are credited. Okay? And treat liabilities, revenues, and the capital the same way. All right? You treat liabilities, capital, and revenues the same way. When they increase, they are credited. When they decrease, they are debited. All right? Okay. Now, these are the basic rules. If you really understand these rules, you're going to be really good. Assets, when they increase, they are debited. When they decrease, they are credited. Liabilities are the opposite. And owner's equity depends on the account, whether it's capital, revenues, expenses, or withdrawal. And capital and revenues are treated like liabilities, expenses and withdrawals, they are treated like assets, yeah. The A. Okay, with that in mind, let's see what they have for us in those slides. See, withdrawals and expenses are deduction from owner's equity. So, transactions that increase withdrawals and expenses decrease owner's equity, okay. All right, so now the concept of normal balance. What does that mean? The concept, what does a normal balance mean?
No, like just not. It's not really not a negative. Just steady. I want to say steady. Just
Where the account should be, logically. Where the account, let me put it this way. Where the account increases, that's where the normal balance should be. So for assets, when they increase, they are debited, correct? So the normal balance of assets should always be on the left side. Yes?
so could normal balance be also like if it's just a steady pace?
Say it again.
If like the balance on a steady pace, could it fulfill a normal balance?
No, what do you mean by steady?
Like if the business is making a certain X amount of like average,
There's no pace with it.
like
No,
average pay, maybe my thing.
That's a different concept.
Okay.
We're talking about, yeah. Where the assets increase, where the account increases, that's where the normal balance should be. So for all assets, the normal balance should always be,
You don't want to see plus 600 on the right for an asset. Basically, it's supposed to be on the left side. You don't want to see on the right. So that's what it makes it.
yes. So the normal balance of all assets should always be on. So what happens if you see a cash with a balance on the right side?
It's not right. So
Yeah, that means you are in the hole.
You in the negative.
Yes, yes.
in the red.
Land, building, equipment, machines, cash, account receivable. No, the normal balance should always be on the left side.
Left side.
Yeah. Right, this rule, where the account increases, that's where the normal balance should be. Where if the account, for all liabilities, liabilities increase is on the right side, correct? On the credit. So the normal balance of all liabilities should always be on the credit side. The normal balance of all liabilities should always be on the right credit balance, on the right side. Okay? All right. For capital, the normal balance should always be on the credit side. For revenues, the normal balance should always be on the right side. Withdrawals, the normal balance should always be on the left side, yeah. That's where it's supposed to be. That's what we say. It's either debit or credit balance. So all assets, their normal balance should be debit. Okay? All assets, their normal balance should be debit. All liabilities, their normal balance should always be credit. All right.
Right side.
Uh-huh. Now, usually, where do we get this information? When we record our transactions, these are your bills. All the receipts, whether they are in your favor or they are against you, all of those receipts that come to your business, those are your transactions. I mean, when I worked in the business office, every day I have a bills, this stack of bills. And then I collect them, and then I come and I take each bill, and I do a journal entry, debit, such and such, and credit, such and such. Each receipt we do a journal entry for. Now, when I did my internship in accounting, I was in Jordan. You were not even born at that time. In 1978, 79. I worked with an accountant from Egypt. He was working in Jordan. And he worked for a guy, he was an entrepreneur. The guy had several gas stations in the town and several flower shops. So he goes every day, collect all the receipts from those and come to the office. At that time, there were no computers. Everything was done manually, by the hand. And the calculator that he used to have, like those ones that you have to move it. You hit and then you move. You hit and then you move, yeah. And we used to do the lines by the ruler. He had the ruler, and the general book was this long, really this long, and this thick. And then we have to do the columns by the ruler. Yeah. So that's what your transactions are. The receipts you collect. You know, whether you have payments of something, whether you receive some payments of cash or on credit, or all of those are your business transactions. But if you ever write a transaction without a document, without a receipt, this is a hot transaction. That's a hot transaction. You cannot write a transaction without having that evidence or the document to prove it. Yeah. Because when the auditors come in, you know, if they catch you, you debited cash or you credited cash for $500. All right, show me the receipt. How did you deduct $500? Where's the receipt? And if you don't show the receipt, you are in trouble.
That's fraud, right?
Fraud, yes, sir.
Don't the audit person come like to your house or your business and start taking stuff?
No, that's if you don't pay your liabilities. They come and take your stuff. Yeah. But see, yeah, you as a private person, you file taxes as an individual. Okay, so I don't think you may not need a CPA, but if your business is for the public, such as hospitals, such as schools, major corporations, they deal with the public. And therefore you have to have a CPA to come and issue a report. And the CPA, when they can issue a good report or bad report. If it's a bad report, the public has to know about it. Yeah. If it's a good report, the public has to. The CPA works for the public.
What does the public have to do with it? So,
Say it again.
why does the public necessarily have to know about it?
Well, because this organization belongs to the public. Like a corporation, for example. You have shares, it's owned by people. They have shares of the stocks.
Oh yeah.
Right?
That's why that one lady got Martha Stewart, she got in so much trouble because she sold all her stocks and she ain't letting none of her stockholders know that they
Yeah, that
were
was, there was something, that's what the Republicans say.
She knew there was her stock was gonna go down. She didn't inform her share.
Everybody should know, yeah.
Yeah.
If the corporation owned by the public, the shareholders are the public, yeah. So therefore, yeah, the CPAs, when they do their audit, they issue an opinion. And it could be a good opinion or a bad opinion, yeah. Okay, so what does that sound? And once you identified you come up with the balance of cash, the balance of supplies, the balance of accounts payable, the balance of service revenue, once you do all the balances, you can see if your work is correct or not. So you have to do a trial balance. Now be careful. Trial balance is not the same as the balance sheet. Be careful here. Trial balance, TRIAL, is not like it's not the balance sheet. All right. Trial balance is a list of all the accounts. Okay. Maybe you can do it over here. So you put your here are your accounts. And debit and credit. So you're going to list your cash, accounts receivable, supplies, building, equipment, all the accounts, and on and on and on. And then you put in it of course, you're going to have a title here. Okay? You're going to say the name of the business, the day, and the name of business, trial balance, and the date. And so, where do we move these numbers from?
From every account.
From the balance on each account. The balance on each account. And then you add the total debit, total credit. If they're not equal, I'll go back to your transactions.
That must take forever. And for big corporations,
Say it again.
that must take forever for big corporations.
No, but once you remember, we said there are some softwares these days.
Oh, yeah.
If you enter, if you do your initial transaction, debit and credit correctly, everything will, the software will give you trial balance, it will give you your general ledger, it give you general ledger for each account, and the balance on each account, it give you income statement, balance sheet, and cash flows, and yeah. The software, all what you need to do is enter the data correctly the first time. And if you enter something wrong, maybe the software will tell you, you'll see the either red number coming out or some signal.
Red number or green number.
Yeah, if you don't see the signal and it was okay, then probably green is okay. And you move on. You enter the data. First you record your transaction on a sheet of paper, you type it, then you put it in the system. And you attach that receipt to that transaction that you typed. Each receipt has its own transaction. You staple it with it, you open it all together, and that's your general journal. Okay, and then the software will give you the general ledger, each account with its balance. Each account with its balance. And it give you a trial balance, give you everything. So, but the thing is, sometimes softwares have glitches. That's why you have to know accounting. Okay, you got to go back and see where you went wrong. Or, because you see, the balance sheet has to carry over. Remember we said that the income statement stops right there and you start a new income statement for the next period. But for the balance sheet, it doesn't stop. It keeps, so you ended up, for example, cash, you ended up for, let's say, $1,000. The new accounting period starts the cash with $1,000. Your building account, the last period, you ended up with $250,000. So when you start the new accounting period, that's your beginning balance of the building, $250,000. And so the balance sheet accounts, they carry over to the next period. So if the software, sometimes the software doesn't carry forward some accounts. Therefore, you have to know accounting. You have to, why did not carry forward? and then you go back to your ending balance from last period. Yeah. All right. So that's the trial balance. The balances of all your accounts. You just remember, you got to put the normal balance. So all assets, their normal balance should always be on the right side. Your liabilities your normal balance should always be on left, right side. The assets on the left side, liabilities, revenues, and capital should be on the right side, the credit. All right. Assets, expenses, and withdrawals should always be on the left side. Okay, so that's the trial balance. Okay, that's all right. Now we're gonna go to the books. We're gonna go to the book. Have you got your book? Did you get your book?
Get it.
Huh?
Getting it though.
When are you getting it?
Sometimes we
This
order
week?
it sometimes we
Did you order your book yet?
I still got the one thing. Trying to stay with my money right now. Around the corner.
Around the corner? Then, when the semester is over, no, it's only 5 weeks. 5 weeks, you got to get your book. This is only 5 weeks. All right? So, that's why, because we're going to use it. So, on page, chapter 2, on page 48. On page 48. Let me clean the board and then we going to start. Maybe you want to help these the ones who don't have the book, these young men. Okay, maybe you can all observe Mr. Manning's book. Because we're going to do all of this stuff here. All right. Okay, what I'm going to do something different this time. I'm going to go to Excel worksheet and do a general journal page. General journal page. All right? So let's go to the Excel. Let's find Excel. Now, how do we find Excel here?
Let me see. You could type Excel in the search.
In here? All right, let's see. Oh, there it is. Well, I don't like this. The old one is a lot better. Okay, oops. What is this? Touch to cancel. That's not. Okay. So the general journal pages look like this. Okay, let me do okay, this is the date. Let me start from here. This is the date. All right, and this is going to be the account. Oh. Account. And this is going to be debit. and this is going to be credit, and I'm going to highlight what is this? Date. Okay, this is ABC text. Let me write it again, date. And this is also text. And these two also, I'm going to rather have it as text. All right. So if I highlight this, borders, right? And then here you're going to put the title, okay? Title, oops. Title, and this is going to be J1, that means journal page 1. J1. Okay? This is going to be J1. See, the journal book is made up of pages, the old one. You know, it's J1, J2. Once you fill up the first page, you move on to the next page. You fill the page until you fill all the transactions. And then once you're done, we want to see each account separately. So we move stuff from here to another book called ledger. From journal to the general ledger. So what did we say general ledger is for? For each account separately. Okay, out of each account, like you will have a whole page just for cash. A whole page for accounts receivable. That's the ledger. Okay, but the journal is you put all the transactions in it like that. And in today's world, you don't have to do it that way. You just type the transaction on one page, attach the receipt, put it in the binder. And the second sheet, second transaction, and all those together is your general journal. Okay. All right. So this is start. You want to all come and observe with him. Let me see if I can use this one. Uh-oh, let me reduce it. It's too big. All right, on July 1st, on the top of the page. Yeah. On July 1st, Blue invests $40,000 in cash to form Blue Design Studio. So what kind of business is that?
Design studio.
Okay, Design Studio. Now what did we say earlier when you start your business? What are the two accounts?
Normal.
No, we are identifying the two accounts first. So what are they? When you start the business, what did we say a minute ago? When you start a business by investing money in it.
Oh, besides one debit and one credit.
What accounts are they? The accounts.
Oh,
Capital.
cash and capital.
Why are you looking there? I want you from your nose.
Oh,
Not from the
It's
book.
right here, I had to go back. You know what I'm saying?
Two accounts are cash and which cash is it?
asset debit.
It's not your personal cash,
Yeah,
it is
it's
that business
business
cash.
cash.
Yeah. So if I were to do a general journal entry, if I do two T accounts, one for cash, I want to make the cash big because many transactions will affect cash. So that is cash. And for the capital, I make it small one, not too many transactions affect the capital. What's the name of the guy?
Guy, like, he told the company, Blue Design Studio.
Blue. No, the name of the guy.
Oh, John Blue.
John's Capital. All right, so this is John's Capital, and this is the cash. The left side is debit, the right side is credit. That's the pluses and the minuses, and the capital, debit, credit, pluses here, minuses there. All right, so this guy started the Blue Design business by investing how much?
$40,000.
$40,000. So the two sides of the transaction are the cash and the capital, correct? What happened to the cash of the business? All right, therefore, where should I put the
On the left side.
is that 40?
Yes, sir.
40,000. And then the capital
On the right,
on the right side for
40,000.
40,000. So, how do I record that on the general journal? I got to put the date first. Which date is it?
July 1st.
Oh, let me put, make all of them text. So I wouldn't be surprised with the formulas and things, yeah. July 1st. July 1st. Usually they make the journal look fancy. They will have a one line for the month and one small line for the day. It makes no difference, yeah. As long as you got one line for got the date, and then
Do you need the year? Or, well,
go ahead.
I say, Lord, I was saying, do they need the year? Or is that just?
It doesn't matter. See, remember the title?
Will be for the year, okay.
Yes.
Okay.
The title, that means the name of the business, trial balance, general journal, and the date, yeah. So we have the cash. The cash, did it go debit or credit? Debit. So under debit, I put 40,000. Okay, and then I have the capital. See, I do like that because,
You got it, then.
yeah, capital. See, the amount is going to go under 40,
What?
oh, 45. All right. Oh. Let me just put these two titles, these two as dollar sign. No dollar sign?
I'll
Oh,
go back, it's right there, to the left.
okay. All right. We gotta do that again. 40. 1, 2, 3. 40. 1, 2, 3. All right. See? Notice I put the cash to the left, and then I put the capital Oh, that's look how the house, it wrote down the capital. To the right side, okay, for $40,000. What's the name of the guy?
Jonas.
F2. John. Capital. All right, John's Capital. That is the first transactions. Normally, you would have to write some notes beneath it. So if I were to write the notes beneath it, what would I say? I would say this is the beginning of the business. He started the business by investing $40,000. That's an initial investment in a business, I would say. If I were to write some notes, okay, but I don't want to write some notes, all right? So the cash so far of the business has in it $40,000 and the capital has in it $40,000. All right, let's move to the next transaction, which is on July 1st.
Cause you said that's
Huh?
you said it's not a business.
Well, okay, just don't look at the title, all right? Okay. On July 1st, John orders $5,200 of office supplies for the Blue Design Studio. All right, now remember, one of the issues we have to decide whether it's recordable or not. It's only recordable when the transaction has occurred. Remember that? We said when the transactions occur, you record the transaction. Now we just went on the phone and ordered supplies. Then nothing happened. He just ordered the supplies. Yeah. Therefore, no journal entry. Okay?
Like once you know, like it don't go through
Until you get the supplies. Yeah. Mhm. So on July 1st, the second one, there is no journal entry to do. All right. On July 3rd now. Let me have some space between each transaction. Third. Okay, what happened on the 3rd?
She rents an office with a Blue Design Studio. She pays $3,200 for
All right. Looks like it's Joanne. The lady is not is a lady. Yeah.
Yeah.
She paid for what did she rent?
Office.
Yeah. So what are the two sides?
Rent.
Rent
32.
and
Yeah, the 32.
cash. Rent. Now, since it's a payment in advance, we call it prepaid rent. Since it's paid in advance, it's called prepaid rent. So what happened to the cash? Did it go up or down?
Down.
So should it be here or here?
Credit.
For how much?
3200.
3,200. And then we have a new account called prepaid rent. Prepaid rent, debit, credit. Did this one go up or down, the prepaid rent?
Down.
Up, it's just being created, yeah.
You just
So the 3,200 is going to be in here. All right? And so on the 3rd, I would do like that. Okay, I do prepaid rent. Under the debit, I put how much?
3200.
Okay, 3,200. And I credit what?
Oh, credit.
Cash.
Cash.
Cash for, it goes under the credits for 3,200. You see? Notice I put the prepaid rent to the left and the cash to the right. That is a proper way, general journal entry. But if you put the cash right beneath it immediately, it's okay as long as you have the amounts in the right place. But it looks bad, it doesn't look professional when you have the cash right. Yeah. So always the debit goes to the left, and then beneath it the cash go to the, or whatever account is credited is going to go to the little bit right, like that. Okay. So if I were to find, what is the balance in cash right now? What is the balance in cash at this moment?
37,000.
36,800.
Yeah, 36,800.
Is it on the left side or right side?
Right
balance.
side.
Left.
Or left side.
Guys, we don't need to guess. This side is larger, correct? So therefore the balance should be on the left side. Yeah, the debit side. And is that the normal balance? Is that okay? Normal balance? Yeah. The normal balance of assets should always be on the left side, or the debit. So it's where it's supposed to be. Yeah. Okay. What comes after the third? On fifth, next one is a purchase of an asset on a credit, right? That's the next one. On July 5th, Design Studio receives the office supplies ordered on July 2nd and an invoice for 5,200. They got the supplies, but they did not pay immediately. You got the receipts for it. So what are the two sides of this transaction?
One is accounts payable and the
Uh-huh.
other one is.
How many of you have been looking at this? Don't look at that
I
thing.
already knew it was accounts
Yeah.
payable. 'cause
So you have a liability now, right? Now what, you cannot debit liabilities in general. You have to specify which account under liability. So in this case, it's going to be accounts payable. What happened to the accounts payable? Did it go up or down?
it went up.
Up. And then what happened to the supplies?
It
Went up, yeah. So one of them assets is increased, so we're going to debit the supplies and we're going to credit the accounts payable. Because it's a liability, liabilities increase, they are credited, yeah. So let me write the transaction here first, and that was the 5th, correct? So I leave a space between the two, and this is the 5th. So I have the supplies. Is that with LYS, supplies?
No.
Or IE, IE?
Yeah, LIES.
Supplies for how much?
Supplies for.
Uh-oh, wait.
200.
Supplies, 6,200?
5,200.
5,200. And then I have accounts payable. See, I have to go a little bit further. For 5,200. See how they are? Now, I have a new account, two new accounts I have. One is supplies. And one is accounts payable. So, debit, credit, debit, credit, plus, minus. So the supplies went up by 5,200 and the accounts payable went up by 5,200. So the balance in supply as of this moment is 5,200. The balance of accounts payable is 5,200. Is it the normal balance? Yes, it's where it's supposed to be. And is it the normal balance? Yes, that's where it's supposed to be. Okay? All right, we go to the next transaction. On July 6th. On July 6th. Purchase office equipment totaling $16,320. They purchased office equipment for $16,320, okay, for the Blue Design Studio. Joanne, I think it's Joanne, not Joanne, I think.
John is a girl's name.
Yeah. Joanne pays $13,320 in cash, and the balance is going to be paid. How much is the balance left?
3,000.
3,000 going to be paid next. So explain this transaction to me.
Okay, so the cash is gonna go down by 13,320.
Okay.
Credit will go up by 3,000.
Which one?
The credit.
Uh,
I would say the debt, cause like accounts payable will go up by 3,000.
3,000, yeah.
Okay.
So so we have a new account. So we have the equipment first,
Oh yeah.
correct? We have the equipment. Is that equipment?
Yeah, that's gonna go up.
Equipment gonna go up by how much?
I mean, it should go up by 13,000.
By the whole
The
amount.
whole amount.
Yes, sir.
1632.
Oh, she
Yeah.
got it, but she still got it.
16,320. 16,320. And then the cash is gonna go down by how much?
13,320.
13,320. And what else?
Accounts payable.
Accounts payable
It's gonna increase by 3,000.
by 3,000.
Yes, sir.
20.
No, just 3,000. That's how much.
3,000, yeah.
This is how much he owes.
All right. So it's still balanced, correct? The debit side, 16,320. The credit side is 13,320, correct? Altogether. So we have a new account now. We have a new account. Equipment. And we have, we already have accounts payable. So, and the cash went down by how much?
13,320.
13,320 negative. So notice I put it under the credit. And the equipment went up by
16,320.
320. And the accounts payable went up by 3,000. See, I put it on the right side. All right? All right, that's on the 6th. Next one is on July 9. Okay, so I go to leave a space between the two. On July 9.
Okay.
What happened on the 9th?
She partially paid for the. She partially paid 2,600 for the amount she owed for the office supplies.
Okay.
So the 3,000 she owed, she paid 2,600.
All right, so the cash is going to go down by
2,600.
2,600. And what else?
The accounts payable is gonna go down.
By the same amount.
2,600.
Yeah, so that means what should I debit now?
Yeah.
I debit accounts payable
Yeah.
because it's going down, it's a liability. Accounts
Credit cash.
payable for how much was it?
2,600.
2,600. And then I credit cash by 2,600. Okay, so I go to the T account now. The cash is credited by how much we said?
2,600.
And
Accounts payable is gonna be on the left side this time, 2,600.
2,600. You see, guys, why do we do T accounts? If I were to find what is the balance of my cash at this time, I immediately add this and see which one is larger. So the balance probably is going to be here. That's the benefit of the T account. Okay? It tells you the summary of the account as of specific date and time. All right? Okay, that's the 9th. What comes after the 9th? The 10th. What happens on the 10th, Manny? On July 10, Blue Design Studio performs services for an investment advisor by designing a series of brochures and collects $2,800 fee in cash. So what are the two sides?
Cash, and one is gonna be, I guess, revenue.
Yes, cash and service revenue.
I guess that's the first sale.
Yes. So the cash, what happened to the cash?
It increased by 2,800.
And what happened to the
It
revenue?
increased by 2,800.
Yes, sir. So I'm going to, is that the 10th? Let me increase my lines here.
So the revenue, all right.
So the 10th, we're going to debit cash now for, how much was it?
2,800.
Okay, 2,800. And then we're going to credit,
Revenue.
is that design revenue or what do you call it? Design revenue?
Yes, sir.
Okay, so we're going to say, as long as you put word revenue, you're good.
Oh,
Yeah. So I'm just going to say design revenue. For 2,800.
And that'll be a T chart by itself, right?
Huh?
Design revenue. All right, let me write that down.
Let me do this with a dollar sign. On those. Oh, I put the percentage. All right. So I have a new account which is design revenue. Debit plus, oh sorry, debit, credit. This is revenue, the plus is on here, and the minus is here. So, and then I have the cash is increased by,
2,800.
and the service revenue increased, design revenue increased by 2,800. Now, usually, guys, you want to put a date here when that thing happened. So you put date here, okay? You put some date to help yourself. You know, where did that come from? Which date?
When did it come?
Yeah. Okay, that's the 10th. Okay, on the 15th, what happened?
They got they perform a service for a department store by design a TV commercial. They billed the company for a $9,600 fee, but
Did not collect the cash now.
so that's accounts receivable, right?
Yes, sir.
Okay.
And what are the two components?
Accounts receivable.
And? Revenue.
Yeah, revenue.
Yeah, design revenue and accounts receivable. So which one went up and which one went
They
down?
both went up.
Both went up. Yes, sir.
You got
So
it.
let me, that's the 15th.
Account, revenue.
Accounts receivable.
No, first it's an asset. Accounts receivable comes first.
Oh, it's not like
Accounts
account payable. They don't understand.
receivable. I hope I write receivable correctly. Is it IEI or IE?
Don't know, ask me.
It's EI.
All right. I got it correct, if that's correct. Accounts receivable. For how much?
Yesterday.
For 9,600.
For
9,600.
4,000?
No, 9,600.
Just, 9,600.
Yeah, that's what it is.
Okay. 9,600, and then design revenue,
9,600. Great.
9,600.
okay, now, let me put the 15 so won't, if you're confused, put it on this side. All right, so, the design revenue went up by 9,600 on the left side, and I have a new account now, accounts receivable. Or, that's a debit, debit,
Think about the gas station.
plus minus 4, 90,
Charge for sodas,
600.
chips, all that.
See, you don't use the cash unless you see the word cash. Unless you see all the word paid. If it says received cash, then you use cash. If you see the word paid, that means the cash is paid.
Oh, I
Yeah.
thought you were talking about
Yeah.
accounts receivable, like they gonna pay you later.
Okay, after the 15th, on the 19th,
They received the 1,400 advance fee as deposit on a series of brochures.
19th,
So I guess you could say a down payment.
Design Studio accepts $1,400 advance fee as a deposit on a series of brochures to be designed.
Okay, so we got a new teacher, right? So that's a unearned revenue.
Yeah,
Correct?
then you look over there.
Nah, I'm just saying, cause.
That's correct. Unearned revenue, that's a liability.
I'd be mad that we just.
And so the two sides are,
Both increasing, right?
which one are they, the two sides?
Oh, one is
Unearned revenue is one.
The other one is cash.
Cash. Did the cash go up or down in this case?
Because they gave us 1,400 in advance.
So that's, the cash increased, correct?
So that's definitely.
And that'll be the, what that's called from earlier,
Cash,
the service,
unearned service revenue.
yeah, unearned.
Unearned design revenue or service revenue?
It's gonna be design revenue,
What do they call it?
unearned design revenue,
Unearned, okay. So, how much was it?
1,400.
Okay, 1,400. And
Unearned design revenue.
unearned design revenue. For 1,400. So we have a new account now. A new account, unearned design revenue. Unearned design revenue, debit. Now, what kind of account is that unearned design revenue?
The revenue is still, I would say, goes up.
What kind of account, first of all?
Credited, right?
What we on?
Is it
Unearned.
Is it assets, liabilities, or honest equity, or revenue, or expense? Unearned revenue.
I think it's a liability, right?
It's a
Because
liability.
it's unearned yet, you didn't get it yet, so it's a liability.
Correct. It's a liability. So when liability increased, credited, yeah. So unearned for how much? 1,400? And the cash increased by 1,400.
Yeah, the plus minus on the revenues.
Huh?
Yes, with some around.
Oh! Unearned. Oh, sorry. I'm just used to the assets. Yeah, you're right. Thank you. All right. That is on the 19th. Let me add some more lines. You see how to add lines and highlight them? So we're still on page 1, journal page 1. What's next?
On July 22nd,
July 22nd.
they received $5,000 cash from a customer previously billed on the 15th.
Design Studio received 5,000 cash from a customer previously billed. What does that mean?
The one that the person they already charged for, they said it was
And
gonna
they
pay
didn't
like
collect the money.
Yeah, they
Now they are collecting.
some of it. That's
So what are the two accounts?
cash and accounts receivable.
Yes.
So
What happened to the cash?
It's gonna go up and accounts receivable is gonna go down since
Yes.
they're paying.
Mhm. So the cash is going to go
5,000.
up by 5,000, and accounts receivable
Right there.
is going to go down by
5,000.
5,000. That means we're going to debit cash for 5,000, and we're going to credit accounts receivable for $5,000. All right. What's next?
July 26th,
July 26. So
paid $4,800 for 4 weeks of employee wages.
okay, let me put those over here. July 26. Okay. Where was I? 20. We did 22nd. Now we are 26. Pays $4,800 for 4 weeks of employees'
So that's gonna go next.
wages.
I mean, wages, expenses, so that's
And?
gonna go up in cash.
What happened to the cash?
It'll go
It's
down.
gonna go down.
Down, yes. So the cash is going to go down by
4,800.
4,800, and then we have a new account now, wages expense. Debit, credit, debit plus, credit minus. That's an expense. So is the expense increased by 4,800. So I'm going to do the journal entry. Wages expense. For 4,800, and let me do that. Put the dollar sign. Wages expense and cash for 4,800. All right, that's the 26. And the what comes next?
The 30th, they receive but does not pay utility bill that's due next month for $680.
Okay, don't open the next page now.
Nah.
Don't open. The Blue Design Studio receives, but does not. It's not. It's like you got in your mailbox your electricity bill,
You don't pay it yet.
and so you're going to pay it, correct? But so you owe whatever amount is in that one.
Accounts payable.
So you owe either utilities payable or
One is the expense, and the other one is payable.
Yes.
So they both go
they both go up. Yeah. So we're gonna. That means we have a new account, utilities expense. Whew. See, every time you have a new account, you have to open a T account for it. Utilities expense, and let's go with accounts payable. For how much was it?
up. $680.
680. Oh, debit, credit, debit plus, credit minus, 680. And accounts payable, 680. So we're gonna debit. Which date is that? The 20?
The 30th.
Is that the 30th?
Yes, sir.
Third is debit utilities expense for 4,800 for how much?
680.
680. And we're gonna credit accounts payable or utilities payable, okay? Payable for 680. All right. What comes next?
The 31st,
Uh-huh.
they withdraw $280 in cash. So
So
The
the two
cash.
sides are withdrawals and cash.
the withdrawals go up and the cash goes down.
Yes. So we have a new T account. Jones withdrawal. And debit, credit. This is a plus, minus. How much did he withdraw?
2,800.
And the cash goes down by 2,800. So if I do a journal entry for that, is that the 31st?
Yes, sir.
We're going to say J withdrawal or John's withdrawal for six, how much we said?
2,800.
2,800?
2,800.
2,800. And then we're going to credit cash $2,800. Okay, so this one is going to be $1 side. And I think, is that all of them, correct?
Yep.
So we only finished one page, one journal page. So that's J1. So the journal, all of that should, if I were to add, let me see if it will, because we put text. I don't know if it will give us a total or not. Let's see.
It should.
Yes, 54,400. And if I were to add this one, that should also be 54,400. Why do we have 94? Let's see.
Oh, good.
40, 3,200, 52, 13, that's 16.
What that is?
Yeah, that was right.
Something is not right.
Probably one of those accounts payable.
Huh?
Probably one of the accounts payable. Cause we still, I mean, it should be short like.
Oh, wait, yeah.
Short like $400, just because they didn't, they paid 2,600 on one of the
Withdrawal,
accounts and they owe
yeah.
3,000 on.
No, wait a minute. Why? What are we adding something not right? Because if you look at this, they don't come up with that much.
Try doing it,
Huh?
try doing the auto sum for the debit again.
For
The left side,
left side?
yeah.
Ah,
That's
okay.
probably this one.
Okay, let me delete that.
Bring out the calculator.
Huh. Starting from here.
Like you said, systems have errors.
And up to here. Oh, we're missing. See, that's That's fine, automatic. So, 94,400, yeah.
Oh, you didn't
I missed-
highlight the 40,000 at the
Yes.
beginning. That's-
Uh-huh. Yeah, 9400, 94. This one should be here, yeah. When I move the cursor one more down, yeah. So that means the work is correct. Yeah, it's balanced. But that's not the key. The key is,
The receipts.
now the key is the balances of the T accounts. Okay, go ahead. The four of you, work on these balances for me. Tell me the final balance of each. Go ahead. Work out the final balances for each of those. For me. I'm going to do the ones with only one number. That's easy. I'll just put this one.
Thanks a lot.
5,200. You guys do the ones with similar numbers.
You gotta start off, let's do cash first, start off with 40,000. Then you're gonna subtract 32. Oh, is that 14,000 or 14,000? Is that 14,000 receiving cash? Oh, no, what? So like, it's 30,000. Plus 30,000.
How much is your cash?
$30,080.
No. Wrong.
Ah,
Add this side and add this side and see which one is larger. And by how much? Yes, do you got to do the two sides.
28.
I'll tell you what they are over here. The balances are. The reason why I told you here the balances are. The cash is 22. After you add all of those, you add all of these, and then this is larger by 22, 480. Accounts receivable is only one number, 46. Yeah, these are on page 55. You will see the.
Oh, you ain't put these two on there?
Nah, that
Oh,
was,
all right.
that's fine. That's fine.
Okay.
Get it?
Yeah.
All right. Now, if we were to do a trial balance, how do we do trial balance?
This the comment.
All right, so you got to put the title,
title.
and then you're going to put the accounts. You're going to list them, all those accounts, the titles, and then you're going to put the balance of each. The balance, just the balance. And so if you look on page, no, on page 56. Page 56, that's the trial balance. Page 56. Yeah, notice the left side equal the right side. Mhm. Okay, we have, I think by, oh, guys, on tomorrow I'm not going to be here. I'm going to the appraisal district. The protesting, they increased my taxes, so I'm going to protest.
Might be all right.
Yeah, and so tomorrow we won't be here, guys, and Monday is what?
The 28th.
We had no school.
No,
Monday.
so today is Wednesday,
Oh, we don't
correct?
have no school Monday,
Yeah,
it's Memorial
today
Day.
is the 23rd, which is Wednesday,
So we got-
Thursday, Friday, Saturday,
That must be
Sunday.
till 29th.
So we'll see you guys on next Tuesday.
The 29th.
Yeah, we'll see you guys on that. And also you will not see me on the 30th.
Hey, so when do we turn in our homework to you?
The homework is due, guys. Since you are guys in class, you don't have to do it online.
Can we turn it to you Tuesday?
Yes, you can.
Okay.
No problem, yeah.
Okay, that's the next
Now,
time I see
if
you.
any person helps other persons will get some, I'll tell you what, this is gonna be not an average, it's gonna be really good points.
Okay.
That's gonna be added to your total directly. I mean, they are precious. 5 points for each one you help.
Okay.
Okay?
Yes, sir.
5 points for each one you help. Let me do the roll, guys. Just 1 second. Come and add your name for me. It wasn't on this list. Yeah.
Yes, sir.
Add your name. It's not here. Okay?
No, sir.
You're not Miller.
I'm Grim.
For this up today, tomorrow.
Today
Oh, yeah, all right.
today is 5/23. So Manning is here,
Always.
and Parker is here, Darian is here,
I need it.
and Ben is
Yeah.
here.
Are you still staying Eastwood?
Still, you stay in Eastwood too?
Yeah.
I stay at Alderman Tree.
Okay, now let me see if I can stop that recording.
I heard about that. So that must recently just changed to Alpine.
Probably like